The recording is going to be available. The recording will be available after the presentation. I'm going to let people jump on. We're going to get started in just about a minute. Okay, we're going to get started. My name is Hannah Baldwin. I'm with Smith, Marion and Company. We are excited to join you today. Pete is going to be presenting on fiduciary accounting and tax filings. As I said a little bit earlier, this is being recorded. Feel free to put any of your questions in the Q&A, and Pete's going to get to them throughout the presentation. If your question isn't answered, there will be a chance at the very end for you to submit your questions. Today we have with us Pete West. He's an EA at Smith, Marion and Company. Pete has over 25 years of experience in tax preparation and accounting experience. He's been with Smith, Marion since 2006, and he's been a partner with Smith, Marion since 2012. He's dedicated to his clients, and he brings a great balance of fun and professionalism to the workplace. Pete's focus is on fiduciary, corporate, and complex tax returns. He also focuses on partnerships and corporations. Pete is a management and business consultant. He works with a variety of clients from nonprofits to governmental housing authorities, as well as for-profit businesses. Pete's involved with Cal CPA, Beta Alpha Psi, and is a member of the Lake Arrowhead Rotary Club. Pete and his wife, Linda, enjoy spending time with their family and their two dogs, Ollie and Monster. Pete enjoys working on his race car and competing in racing events. In all of his interactions with clients, Pete strives to build a trusted relationship. He is a wealth of knowledge and enjoys educating clients as well as others in the profession.
So I'm not sure if you just cut out for me or for everybody, but that last little blurb about me personally, yes, I do have a wife of 35 years and dogs and a race car, and so I like to do some stuff outside of work as well.
I think my connection dropped a little for a moment. I'm going to give it over to you.
Okay. So I just clicked through a couple of slides, but you know, kind of talking about Smith, Marion and Company. Welcome everyone. Thank you for joining us this morning and allowing us a chance to talk to you a little bit about fiduciary, tax return filing and accounting, and all the things that go along with being a fiduciary. And so hopefully we can educate you some this morning. We're going to talk about kind of the beginning of a fiduciary duty, I guess, as you start, if you become a trustee or an administrator for a trust. One of the first things that have to be done is a federal ID number for the entity, deciding what kind of a fiscal year to use and what exactly are the filing requirements. You may or may not have any filing requirements depending on what the assets are of the trust or the estate, but it's certainly good to find out, because you as the fiduciary, or if you choose to serve as fiduciary, would be responsible for ensuring that any filings that are required have been filed. Okay, next, we're going to talk about the duties of the fiduciary. What kind of record keeping requirements, how do you determine and when do you determine to make distributions, and ultimately closing out the entity, whether it's an estate or a trust. And then we're going to talk about the really big question that always comes up both from the fiduciaries and from the beneficiaries of trusts and estates is, am I going to be taxed on this money that I'm receiving or the assets that I'm receiving, and who's going to pay the tax, And is there anything I can do to reduce that amount if there is taxable income? So we'll talk about all of those items. And as Hannah mentioned, you are free to raise your hand at any time and ask a question. I will also ask questions at the end, but with the number of people that we have here, we can pretty much address questions as we go along. And then you may still have some additional ones at the end. So let's keep on moving. So the initial requirements, federal ID number. Now, a lot of times your accountant, if you're using one, or the attorney, if they're involved, will apply for the federal ID number for you. So you may or may not have to deal with that, but you do have to be aware what it means. Fiscal year, you have some options there potentially. Depends on whether it's a trust or estate. We'll talk about that. And then not only are there the fiduciary returns, the Form 1041, but also the decedent's final return and potentially gift and estate tax returns. Those all fall within the purview of the fiduciary once you take on that responsibility. So applying for the EIN, you can read the blurbs yourself, but essentially a trust or an estate becomes a separate legal entity from the grantor or the decedent on the date of death. Now we're talking primarily about what, the most common type of trust, which is the revocable living trust, the kind of trust that people set up to make sure that they can avoid probate. So while that trust exists, it is not a separate legal entity from the grantor of the trust until their death. And so that creates some issues with the filing of the EIN a lot of times. And that is that on the SS4 form, which is used to apply for the EIN, there's a question that asks for the date the entity was created. And a lot of times people will put there, if it's the irrevocable, if it's the living trust of Bob Smith dated January 7th, 1997, what they'll do is they'll put January 7th, 1997 on the SS4 form. And what that means, the IRS says is, okay, where are the last 24 years of returns that you haven't filed? Because they're now thinking that this legal entity was created back in 1997 and they haven't received a single tax return since then. So the date that the entity is created is the date of death of the decedent, not the date that the trust was created, unless you are creating an irrevocable trust, which is, we're not going to deal with those items in this particular webinar. So if you are going to act as the fiduciary, you have to put your social security number on the SS4 form. Yes, you are going to be inextricably linked as far as the IRS is concerned, and you are the one that they're going to come looking for if they have an issue with the trust filings or the estate filings. So you want to make sure that you understand that there is, responsibility and accountability that comes along with serving as a fiduciary, and just keep that in mind. When that's done, you are going to receive a Form CP75 or a letter CP575 that assigns the EIN number, has it at the top. You're going to want to safeguard that document, and you will end up having to provide lots of copies. If there are multiple financial institutions involved, they're all going to want copies of this form showing that there has in fact been a federal ID number assigned, and it's assigned to the trust, and then they're going to issue all of their 1099s and other documents to that EIN number and file copies with the IRS. So important to get this right if you are going to do it yourself. Even if you are doing it yourself, don't hesitate to call us. And I would, if the choice is there, I would prefer to do it rather than allowing the attorney to do it, because many attorneys get some of the things on there wrong. They're not tax preparers. They're attorneys, and this is not something that takes a long time to do. It's a single page form. So if you have the choice, let us do it instead of allowing, or your accountant, instead of having the attorney do it. Okay, fiscal year. A trust does not get to choose. So if person just creates a trust and the trust becomes a separate legal entity from the grantor, it is required to file on the same year as an individual for the grantor, which is a December 31st year end. And that means that if you have a trust that's created on October 1st, yes, there's still going to be a filing requirement if there is income for that short little year from October 1st to December 31st, and then potentially more returns after that. So not a whole lot that we can do about that. You can still do some things with timing, and we'll talk more about that when we get to the taxable and non-taxable income and the filing requirements in particular. Now, estates can opt to use any fiscal year that ends no later than 12 months after the end of the month in which the estate was created. So if you have a person that passes away on July 7th, you can choose a fiscal year up to July 31st of the next year. Why is that important? It allows us to potentially limit your tax filing requirements to a single year. We can be filing a initial and final return if we can wrap up the estate within that 1 year period. Would be very difficult to wrap up an estate, as the example that I gave for the trust, that's something that's created in October, would be very difficult to wrap up by December 31st. You're going to need court input, you're going to have other things going on, and it's just not going to happen in a matter of 3 months. And so flexibility is the primary benefit of the non-calendar fiscal year. It just allows us to kind of pick and choose where certain events happen. So if there is a residence that has to be sold, or other real estate that has to be sold, or things that have to be liquidated that are going to cause a gain, or other taxable events, it is possible to kind of mass those all in a single fiscal year, and again limit the number of tax return filings that we have to submit.
Pete, a question came in.
Okay.
Does a trust have to file a return in a year for which there is no income?
The answer is no. The threshold, and I will might even be on the next slide. Haha, look at that. So any fiscal period in which there is $600 or more in gross income, or any taxable income. So gross income would be anything that is sold. So for instance, if you sell $10,000 worth of stock, even though there is a loss on the stock, you would still have to file a tax return, because the $10,000 exceeds the $600 in gross. So there is reportable gross income, or taxable income, and there is a $100 exemption. So if you have just minor interest from a bank account, you would not have a filing requirement for that particular year, because interest income, as it's reported, is both gross and taxable, is the same amount. So if you have $25 worth of interest, that's $25 of gross income and $25 of potentially taxable income, but you have a $100 tax exemption, so nothing to report. As I stated, it's possible to use timing to limit the number of required return filings. So for instance, if you have that short year beginning the initial year, if there's no activity in that year, then we may not have to file a tax return for that short year. Then you could do all of the dispositions of property and stocks and anything else that may be in that full, year two, essentially. And even though you haven't distributed all of the assets of the trust or estate by the end of the year, if the remaining assets are sitting in just the interest-bearing savings account and are earning minimal interest, then you would potentially not have further filing requirements after that big year where all of the transactions happen. So the due date for the first return or for any return is the 15th day of the fourth month. So April 15th for a calendar year, just like an individual. And a 5-month extension is available. For individuals, it's a 6-month extension, but because an entity return has to be able to get those K-1 forms out to the individuals that may have to include income on their personal returns, there is a lag time of 1 month. So September, actually, I think it's September 30th that the 1041 extension goes to. So it's actually 5.5 months, but figure 5 months, sometime in September, that return has to be filed at the latest for a calendar year. So the fiduciary is also responsible for filing the decedent's final individual tax return. So that's a normal 1040 form, and it would be for all income received by the decedent before the date of death. A lot of times what we end up with is we end up with commingled forms at the end of that first year, where either all of the income is being reported to the decedent for a investment account, for instance, or some of it is intermingled and we kind of have to divide it up. And if the estate or the trust is relatively small, we may just choose to include all of the income on the individual tax return, report it that way, and thereby not have to file that 1041 form. Other possible filings, 1099s. So 1099s would be reporting income to someone else. If the entity uses an attorney or an accountant and they are not incorporated and they pay them more than $600 in 1 year, the requirement to send them a 1099 is there. Same with the fiduciary. If the fiduciary is receiving fiduciary fees, they should receive a 1099 form because those fiduciary fees are taxable income to the fiduciary. And then the 706 and 709 forms, we rarely see those. 706 is the estate tax return. And so this is when an estate is actually taxable, and whether it's a trust or an estate doesn't matter in this case. It's a matter of what is the total value of the assets that are being transferred by the decedent. And the current exemption amount is 11 million per individual, 22 million roughly, and not the exact numbers, but 22 million for a husband and wife. And so if your estate or trust has assets totaling close to that, then certainly the possibility exists that we have to do a whole lot more work. Valuations of assets to make sure that you're actually not exceeding that threshold of having to file the estate tax return, and then filing the estate tax return and potentially paying the estate taxes. The 709 form is a gift tax return. Some trusts will have provisions for gifts in them, and then a 709 form may have to be filed. And so the 709 and 706 are reporting requirements because both count against that $11 million per person threshold. And that's a moving target that changes whenever we change the tax code. So right now it's 11 million. Prior to that, it was 5 million. And we'll see where it goes from here.
We have two questions that came in.
Okay.
First one is, what if the individual is alive, but has been declared incompetent and cannot deal with finances?
Okay, so that's a little bit of a different type of trust, but the same thing occurs. So when that happens, the trust that you're dealing with is an irrevocable trust, so it is a separate legal entity from the individual, and can be named a special needs trust or a perpetual trust for the care of an individual. And so as such, you have the same filing requirements as far as income goes, as far as everything else goes. And the living individual is then going to generally be the beneficiary as well. And so even though there may be a 1041 filing requirement, all of the income generally flows through to the beneficiary and is taxed on the individual's tax return. And you as the fiduciary then are responsible both for filing the 1041 and filing as the conservator of the individual, filing their individual tax returns.
And then one more question, Pete. The question is, will my life insurance policy money be taxable upon my death?
Life insurance is not taxable. And it's also generally not included in the trust or the estate. It is included if there's cash value of the life insurance. So if it's a whole life or universal life policy, then the cash value is included in the individual's estate as far as valuing the estate. But life insurance is generally paid out directly to a beneficiary, not through a trust or an estate, and it is not taxable. So next, we're going to talk a little bit about the fiduciary duties, record keeping requirements, distributions, and closing out of the entity. A fiduciary is a person who holds a legal or ethical relationship of trust with one or more parties. So what that means in a nutshell is you are supposed to act with the best interest of the beneficiary in mind, not your best interest. However, as I stated, as a fiduciary, you also have legal responsibilities and legal liability. So while you're acting in the best interest of the beneficiary, you also have to make sure that you safeguard yourself from liability, from taking actions. And sometimes, if the beneficiaries are asking for distributions right now, it's like, I want all of my money. You can't do that unless you are certain that all of the entity's liabilities have been taken care of, because otherwise you're going to be left holding the bag. Okay, you're not going to get that money back from the beneficiaries in order to pay the tax that may be due, or to pay the attorney's fees or the accountant's fees, court fees, so on and so forth. And so make sure that while you're taking good care of the assets of the trust or the estate, you're also looking out for yourself in not leaving yourself with any legal or financial liability. You do carry the legal responsibility for compliance with all tax regulations, so tax filings, and I'll talk more about the due dates and that later on. And then you're supposed to follow the trust document, the will, or court order in the case of an estate where the decedent died intestate. Record keeping requirements. Make sure you keep track of everything, all expenditures, all distributions. It is preferable to do everything through a checking account so that there is a good record of it. I would not, even if there's cash involved in the estate of the trust, deposit the cash immediately so there's a record of it, and then distribute money from there. The tax records. So not everything obviously is going to lead to a deduction on a tax return. You're going to have potentially the costs of a funeral, miscellaneous costs that go along. None of these are deductible on a tax return, so they are important in terms of keeping track of what you did with the assets, but not so important in terms of tax returns. But tax return requirements are the same as for your individual tax return. You have to maintain records for a minimum of 4 years from the date of filing of the return. So we simply say keep everything for 5 years from the date on the return. So if it's a 2020 return, after 2025, you can get rid of it. But the important part here is the date of the filing. If there is a filing requirement and you never file a tax return, that date never ends. So it remains perpetual. Now, is the IRS going to come after you for a return 20 years after the fact? Probably not. But that's just something to keep in mind. If there is a filing requirement and you don't file a return, that clock never stops. You're also responsible to prepare accounting reports for the court or the beneficiaries as necessary. With smaller estates or trusts, that's usually not a problem. You have a limited number of beneficiaries. They may be happy just getting a tax return and getting their distributions. But for estates, you will definitely, if you are in probate, you will definitely have to provide the court an accounting and show what is happening to the money, where it came from, where it's going, and what's available for distribution. And finally, you may be eligible for compensation. Usually the courts will set for estates. They have a formula that says, this is how much the fiduciary is allowed to receive. Trusts sometimes have fiduciary compensation built into them. You can refuse it. You cannot take it. If you're the only beneficiary, obviously it doesn't matter. But I can tell you that having dealt with many trusts and estates and many beneficiaries, if you have a good size estate or trust that you're dealing with and multiple beneficiaries, you are going to earn that compensation. In most cases, there will be a lot of things happening and a lot of work that you have to do, and you should definitely be compensated for that.
2 more questions come in.
Okay.
One, can a trust be challenged if the owner is incompetent, if the family member or a family member is unhappy with the choice of a trust fiduciary?
Well, the reality in our legal system is that anyone can sue anyone for anything. Absolutely, a beneficiary is allowed to challenge the selection of the fiduciary, but they will have to show why that fiduciary is either not performing correctly or why they should not be trusted with the assets of the trust in order to get a court to make a change. So if the grantor of a trust, for instance, says Bob Smith is going to be my trustee, after I pass away, he's going to be my successor trustee, and then the beneficiaries decide that they just don't like Bob because Bob's not giving them their money right now, that is really not going to be a big issue. They have to be able to prove that there's actually some malfeasance or something happening that's not supposed to be happening.
And then what about this next question says, my business's landlord died. I don't know if he has an irrevocable trust. Who do I pay rent to?
Good question. So initially, I would simply continue to send rent payments the same way that you have before. Just make them to the individual, even though the individual is deceased, and let the administrator of the estate or the trustee of the trust, depending on what it is, inform you that, hey, as of from this point forward, please make checks payable to the estate of or the trust of, and go from there. Usually the individual's accounts are kept open for some period of time. And so they're going to continue to be able to deposit monies made out to the individual's name.
And we had one more question come in. Does compensation and its amount for the fiduciary have to be written into the original trust documents, assuming the courts are not involved?
Generally, yes. I mean, that's more of a legal question, but yes, if the trust does not include a successor trustee, usually another family member, and doesn't have a provision to pay fiduciary fees, then you generally can only get compensation if you are a third-party trustee that gets substituted. In other words, if whoever the successor trustee says, and you don't have to serve as a trustee. So if you're seeing, hey, I'm not going to get any compensation for this based on the trust document, and I know I'm going to be in a protracted legal fight with my siblings or some other beneficiaries because they're already telling me that they're not going to be happy with whatever the distribution is, you can simply say, hey, I don't want to be the trustee. I'm not going to serve as the trustee. But unless the trust says that there's going to be compensation, you aren't going to be compensated for that time. So then the whole thing goes to court, and another trustee has to be appointed. And at that point, the court can assign fees. And they could even come back to you and say, hey, are you willing to serve as the trustee if we provide you with compensation? So.
And then another question came in. If there is intentional malfeasance by a trustee harming the beneficiaries, is this a civil or criminal matter or both?
Potentially both. Initially, it's going to be a civil matter. Initially, it's going to be the beneficiaries will have to take the trustee to court, and then if the court determines that there was criminal malfeasance, then they can refer it for that. Now, if there is definite proof of or the appearance of legal malfeasance, then you could also go directly to the district attorney's office. But generally speaking, they're going to want you to settle that in civil court. All right. Moving on, distributions. So it is your responsibility to distribute assets as soon as they are available, while maintaining sufficient assets to meet the financial requirements of the trust. So again, you're walking that fine line between how am I taking care of my responsibilities and my liability, and how am I taking care of the beneficiary. So I mean, it's pretty simple. If a trust simply says, split the assets between 3 siblings, doesn't require a whole lot of time generally, other than to liquidate the assets and then go forward. But you do have to maintain enough funds ultimately to be able to meet any tax liabilities or outstanding payments to vendors. So final distributions can be made quite a ways after the entity no longer has a tax filing requirement. And so, just because all of the assets have not been distributed and you're still holding on to some reserve for tax payments and legal fees and so on and so forth, doesn't mean you can't file that final return and say, okay, I'm done. You just have to make sure that whatever the remaining assets are, they're sitting just in a savings account or a checking account, so they're not earning enough income to cause another filing requirement for a tax return. And you can hold that reserve for an extended period of time, but it does have to be a reasonable amount. So, if the entire estate was $100,000 and you're telling the or you're dealing with a fiduciary as a beneficiary, and they're telling you that they have to hold $50,000 indefinitely. That's unreasonable. I mean, there's no way that there's going to be a $50,000 tax liability. There's no way that they should be incurring $50,000 worth of legal fees on a $100,000 trust or estate. So but certainly 10% is a reasonable amount. If there is a potential tax liability, it could be more. Tax rates between federal and state can be as high as 40% or 45%. So so there may be times when 50% held back is the proper amount, only because of the potential tax liability that exists. And so closing out, estate requires court approval. So this is what usually holds up most estates, is that if you get lucky, you can get a court date in 6 months. And if you have all of your records in good order and a proper accounting of what the assets are, then you may be able to get done with 1 or 2 hearings at the court, and they simply approve it and say, yes, thank you very much. You can now send out the distributions. You may hold, X number of dollars in reserve, and you're done until that final amount is being done. Obviously, for a trust, you're going to make those final distributions based on the trust document. There may be charitable beneficiaries that are included that are supposed to be paid a certain dollar amount or a certain percentage. But the tax return closeout does not have to coincide with those final distributions. Again, we try with most small estates and trusts, we can get away with doing a single tax return, single 1041 that is both the initial and the final return, because there's not going to be any more income received by the entity. So there's not going to be any further filing requirements after the liquidation of most of the assets. And the limitation remains at $100. So these days you could probably have $500,000 in a savings account, and you're not going to get $100 worth of interest in a year. So we're not having much trouble in terms of bank accounts generating enough interest to get you in trouble with this.
A question came in.
Okay.
If the owner of the trust, being alive and unwell, is in need of income from the trust for his care, being residential care or at-home care, will he be taxed on withdrawals for the care?
No. So just like a business entity, the only thing that you're taxed on is the current income. So let's just say the trust starts off with $1 million and receives $50,000 in dividends for the current year, but you withdraw $80,000 because those are the costs of the care. The tax is going to be incurred only on the $50,000 of current income, not on the $80,000 of distribution. So it doesn't matter what gets distributed; it only matters what the current reported income is for the trust or estate. Okay, so that brings us to our final section here, which is the one that everybody wants to know about. What's actually taxable, and we've already covered a little of that, and who pays the tax, and can I avoid some of that taxation, or can I get some timing and move some of the tax liability potentially into another year. So the inheritance itself, the assets held by the grantor are and distributed to the beneficiary are not taxable, unless, and those are the exceptions, the accounts or the amounts were deferred income amounts in the hands of the decedent. So if I pass away and I still have $1 million in my IRA, that $1 million is going to be taxable to my beneficiaries regardless, because I never paid tax on that money. I deferred the income when I put the money into the IRA. And so it retains that character going forward. And then the gains and the earnings of the entity are also taxable. So as soon as the entity begins its existence, it gets a stepped up basis right now. So we have under current rules, everything is valued at the date of death, or the alternate valuation period, which is 6 months after the date of death. And so if it's sold the next day, generally there are very little gains in terms of capital gains. But if an estate or trust drags on in some cases for years because of legal battles and so on and so forth, then you could have potential income and gains on the assets of the entity before it is finally closed out. Okay, and you do get deductions. Legal fees and accounting and tax filing fees are deductible currently, as are fiduciary fees and taxes paid. And then costs related to production of income, these would be like brokerage fees and investment interest expense. Those are also deductible on the tax returns. And some of these will not be distributed out to the beneficiaries unless it's the final tax return. So there's another reason why we want to try to wrap up a return as quickly as possible, particularly or an estate or a trust as quickly as possible, particularly if there is significant income in a particular year. If we can make that the final year, then there would be expenses that pass through to the beneficiaries along with the taxable income. So there's some offset there.
There's two questions that came in.
Okay.
Our family trust has an attorney as well as CPA firm that files the tax returns. At the end of the year, is the attorney required to prepare a report to the beneficiaries? No, the attorney is not required to prepare anything that he is not specifically retained to do. So he would not normally do an accounting to the beneficiaries. Now, the tax return usually serves kind of as an accounting, and certainly the CPA would have to have some sort of underlying transaction accounts to be able to prepare the tax return. So it's probably easier for the CPA to prepare something. But the fiduciary can send the full tax return copy to each of the beneficiaries. Generally, they only receive the K-1 form, which is just their portion of taxable income. But as the fiduciary, you have the you can share whatever you want with the beneficiaries, but there's no formal requirement for an attorney to prepare an accounting, or for an accountant to do it either. And then another question is, does the trustee or trusted family member have wide latitude on how to manage a large asset pool prior to death, or is this a pre-estate matter?
Yeah, so the successor trustee has no control or pre-death. They have no way of influencing anything that is being done with the trust, and the estate obviously doesn't even exist yet until the death of the person who owned the assets. So no, I mean there's nothing pre-death that a successor or an administrator can do. All right, who gets to pay the tax? It ends up being to some extent the fiduciary's choice. However, because you as the fiduciary or a fiduciary has the supposed to have the best interest of the beneficiaries in mind, it's generally not a good idea to have income taxed at the fiduciary level on that Form 1041. The reason is that a single individual reaches the highest federal tax rate at about $400,000 of income, whereas a trust or an estate reaches that same tax rate at just $12,000 of taxable income. So, unless it's a very small estate or is going to have minimal income, then it's probably not a good idea to have tax applied at the fiduciary level, at the 1041 level. You'll also only have that small exemption amount. You have $100 of income that is exempted from taxation entirely, whereas even a single individual has a $12,000 plus standard deduction, so they don't pay any income on the first $12,000 of taxable income, or sorry, they don't pay any tax on the first $12,000 of income. So potentially, you could be distributing that same $12,000 that would be highly taxed at the fiduciary level to individuals, and they would not pay a dime in tax. So now that second blurb there, if the distribution is required, okay, and so when I say required, if the trust says that 50% of income goes to this beneficiary and 50% of the income goes to the other beneficiary, then that is a required distribution, and it would be, it would automatically get applied generally on the K-1 form to the individual's returns. But if those distributions are discretionary, then and we've had the question of the trust set up for a living individual. There are, unless that trust is set up to say that all income has to be currently distributed, then those distributions are then discretionary. And that means that if no actual distribution of the income has been made within 65 days of the end of the fiscal year, then the fiduciary is not allowed to take a deduction on the 1041 for the distributed amount and would have to pay the tax at the fiduciary return level. So gets a little complicated. Not usually a problem with the estate or a trust of a deceased individual. So things to remember: make sure that the beneficiaries know that they may be getting a K-1 and that they will have to include that on their tax return. Happens all the time that we try as best as we can to get a 1041 filed early in the year, as soon as we get the investment statements. Sometimes that takes until late February, early March to get the final investment statements for the trust. And then we prepare the returns, and we find out that the beneficiaries filed their tax returns on January 19th, when the IRS opened up electronic filing. And now we're looking at filing amended tax returns for those individuals because they didn't include all of the income on their tax return. So it's always better to let the beneficiaries know up front that, hey, you are going to be getting additional income that may be taxable to you, and don't file your tax return until you have these forms. And consider the tax liability of the entity before making final distributions. Just to recap there of if you know or think there might be additional tax liability for the entity, then make sure you hold enough in reserve to be able to cover that. Do you have some more questions?
Yes. Let's see, K-1 is needed even if those required distributions are non-taxable inheritance income. I think that's a question. Is a K-1 needed even if those required distributions are non-taxable inheritance income?
Right. If there is no taxable income, or if the taxable income is minimal and the fiduciary simply decides, hey, this is all going to come in at the lowest tax rate on the fiduciary return, so I'm just going to make it easy for the beneficiaries and pay the tax, Let's say you have, $2,000, well, or let's even say you have $20,000 of income, but you've got $12,000 in legal fees and another $3,000 in accountants, and you paid the property taxes on the property to the tune of another $3,000. So you really end up with $2,000 of taxable income. You're talking then about $300 in income tax, most likely $300 to $500. If you've got 20 beneficiaries, does it make sense to send each of them a K-1 for some little portion to include on their tax return, or is it better just to pay the $300 to $500? And I would say at that point, you make the decision, I'm just going to pay the tax at the fiduciary level. Nobody gets a K-1. They don't have to worry about it. And if there is no taxable income at all, then even if we send you a K-1, it's going to have nothing on it. Going to be all zeros. So yeah, nothing to include on the personal tax return in that case.
And then based upon who pays tax, if the trust is an IRA and is for education for a grandchild, does this mean the trust can pay the tax on, for example, college tuition?
Well, so again, the distribution of money does not create a taxable event. Only the income, and so if the trust is holding an IRA and it withdraws money from the IRA, it's going to be taxed on the withdrawal from the IRA, not on what it ultimately distributes to the individual for the college. So, again, the taxable income and the distribution are kind of separate from each other. And if you're using, or if you're creating a tax liability by taking a distribution or even selling a stock, it doesn't necessarily have to be an IRA. So let's say that the trust is holding some stock that has gone up astronomically, and the distribution required is $20,000 for the year of college. You're not going to be able to just liquidate $20,000 worth of stock because there's a tax liability there as well. You're probably going to have to liquidate $24,000, $25,000 of stock so that you can pay the tax at the fiduciary level and then still have $20,000 in cash to distribute for the college. Okay. So finally, deferral possibilities. And we see this a lot of estates, a lot of trusts end up with IRAs or 401k accounts that still have balances in them. And if you simply liquidate those accounts, it's all taxable. It's all taxable in the current year. And that could potentially create a pretty significant tax liability. Now, the nice thing about these accounts is that you can actually transfer them to the beneficiary and let the beneficiary decide how to deal with the distributions, which are going to be taxable distributions. So this again is going to require you to have a conversation with the beneficiaries, or for if you're the beneficiary, for you to talk to the trustee and say, hey, I don't want to pay tax on 100% of my granddad's IRA that I'm inheriting. I would much rather move it into a beneficiary IRA for myself and have some amount of time to take that money out. No, we currently have a 5 or a 10-year period, or depending on who you are, you may even be able to take the distributions from the IRAs over your lifetime. So there's a lot that goes into figuring out what you're allowed to do, but you may not want that additional income, particularly in the year in which a trust or estate is liquidated, because there may be other income, and so you're going to get everything taxed at a higher tax bracket, where you're much better off being able to spread that income over several years and time when you're taking it, and your tax rates are going to be at the best level. And And you can distribute the actual trust assets. So, if there are houses inside of the trust or the estate, as long as you can equitably split them up between the beneficiaries, you don't have to sell the assets. You don't have to sell the stock if there's going to be gain. You can distribute the actual stock. You can distribute the real estate, and then use whatever cash there may be inside of the entity to equalize that. So if you have, let's say 3 rental properties and 3 children, but there is a valuation difference of $50,000 between the highest and the lowest, then you would simply make up for the difference with cash distributions to the other beneficiaries. But again, that carries with it some liability to the trustee or administrator, because you definitely would want to get good valuations on the property. You don't want to end up getting sued by one of the beneficiaries for being shorted. And more questions yet? Or all right. So I think we're at the end of the presentation and are open for general questions.
Okay, let's see. Can you transfer an existing 401k or 457 into a revocable trust?
No. And the reason the answer is no is that by definition, those types of accounts must have an individual or they can potentially be held in a trust, but the trust has to be a revocable trust at the time. So it's really a disregarded entity, and it's really still the individual that is responsible for any tax payments. What you can do with those monies is to, again, create beneficiary IRAs out of them. So you can't transfer a 401k plan. The 401k plan or 457 plan is applicable only to the individual who worked for that company, except for maybe a spouse would be able to continue to receive payments from a 401k plan if that's the way the 401k plan is set up. But any other beneficiary that is going to get a portion of that money will have to have it transferred into a beneficiary IRA in order to continue to defer that income.
If the investment in the trust is a dividend account, what happens to the monthly dividends if the owner of the account is no longer living?
So the dividends are simply, either reinvested or sit there as cash in the investment account, and they are taxable in the year in which they are received or reinvested. So it continues on just as it has while the individual was living, and the tax liability is exactly the same.
And we'll do one more question. This one is, what are the major differences between a revocable trust versus irrevocable? And is there a simple formula to decide which is best?
Okay, so a revocable trust is generally one that you set up during your lifetime for the purpose of avoiding probate, like a living trust. Irrevocable trusts are of 2 sorts. They are revocable trusts that have become irrevocable by the death of the grantor or grantors, or they are specifically set up trusts that meet a certain purpose, such as intentionally defective grantor trusts or charitable remainder trusts, charitable lead trusts, charitable annuity trusts. So their trusts for estate planning generally are irrevocable trusts that are set up during the life of the grantor, are used generally for estate planning. And yeah, that's a subject that's way too deep to get into here or even in an hour. Yeah. Any more?
That is it. Thank you so much, Pete.
All right. If you have any further questions, don't hesitate to contact me. I've got my contact information here, and I think Hannah will give you our general contact information as well. Happy to say that we are now proud owners of a .cpa domain, so we have kind of shortened our domain name for our website and for our email. Because as a CPA firm in the US, we are allowed to use .cpa. So thank you very much for attending this morning and joining us. And please let us know if you have any questions.
Yeah, thank you everybody for attending. You will get a short survey afterwards. No need to answer it, but at the very end it asks, is there any specific topics you'd be interested in the future? So even if you don't answer anything else, be sure if there's a topic that you're very interested in, that you do put that in there, because we do look at those and we do use that to help decide what webinars we'll be putting on. Again, this session was recorded today. I'll be sending out the recording to everybody who attended, as well as the slides. So thank you so much. I appreciate everybody for attending. Have a great rest of your day.
Bye-bye.